Hello and welcome. I'm Real Crowd CEO Adam Hooper, and this is the Real Estate Investing for Your Future podcast. Here we explore the latest in commercial real estate trends, insights, and investment strategies that passive investors can use to build real estate portfolios that last.
All opinions expressed by Adam, Tyler, and podcast guests are solely their own opinions and do not reflect the opinion of Real Crowd. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. To gain a better understanding of the risks associated with commercial real estate investing, please consult your advisors.
Our guest today is Kris Benson, Chief Investment Officer at Reliant Real Estate Management. In today's conversation, Kris discusses today's self-storage market, the factors that drive consumer demand for self-storage, and the key factors he looks at when reviewing a self-storage property. We hope you enjoyed today's episode with Kris Benson. Kris, thank you so much for joining us today. We're excited to talk about self-storage, which is definitely a hot topic for our listener base, and we thank you for coming on the show to share your thoughts.
Yeah, my pleasure. Appreciate the opportunity. I'm certainly biased, but I like self-storage too.
Good. So why don't you tell us a little bit about how you got started in real estate, what you're doing with Reliant, and how you ended up coming on board with the Reliant team.
Yeah, happy to do it. So my background actually, Adam, was in sales. That was my first job out of school. Worked for a few, first business-to-business sales, and then in a medical device arena. And when I was about 29, I decided that there was no way I was doing great. It was, as many of the people listening here know, you're trading your time for money, and I was making money and checking boxes as far as moving up in my career. But the thing I realized really quickly was I wasn't controlling my time. And, you know, I still remember waking up in the morning and saying, I can't do this another 30 years. Just kind of the pit of the stomach feeling, you know what I mean? Mm-hmm. And so we got into residential real estate as an opportunity to start to build some passive income. So the idea was, you know, initially we were going to build out a portfolio large enough to replace my income, or at least cover our expenses, and then, you know, work became a choice. Very quickly I realized I hated all things residential. We had about 20 units, and it wasn't necessarily the work, you know, plumbing, electrical, that kind of thing. We had most of that outsourced, but it was the people. It was really soul-sucking, Adam, if I'm being honest. And I wish I could give credit to who said it. I either read it or heard it, or I have no idea where it came from, but the quote was, big deals and small deals are the same amount of work. You just make less money on small deals. And I said, oh, we just need to go bigger. So we sold all the units we had. So we had a little bit of capital, and I'm making a very long story short, but we ended up developing a 64-unit apartment complex. And really for me, Adam, that was like the light bulb, like, oh, this is how you make money in real estate at scale. And so I did multifamily personally for a number of years. We built and bought a few of our own facilities. And then I realized that there was opportunities like Real Crowd has with passive investment. And so started to place some capital with other sponsors who I knew were doing a better job than I was. And about 5 years ago, I was convinced that cap rates couldn't possibly compress any further in multifamily. Whoops on that one. I was convinced that values couldn't possibly go up anymore. So I was like, I got to get into another asset class, and started exploring some operators on the self-storage side of things. And the original plan, Adam, was to just be a LP, right? Just to deploy some capital with them. And self-storage and mobile home parks were the two things I liked the most. I'm a data guy, and we can kind of get into why I like them. So I met with a bunch of operators, and Reliant, the founding partner of Reliant, is a guy by the name of Todd Allen, and his partner Lou Pollock. And I met them, and we formed a great relationship. I invested with them, and about 5 years ago, we essentially created a partnership, and they needed some help on the capital raising side and the capital market side of the business, and I had some experience doing that in my previous lives. And we've been on fire ever since. So Reliant now is a vertically integrated self-storage operator. We're buying and managing our own properties primarily across the Southeast. It's been a fun transition and journey for sure.
That's a pretty interesting path then. So from an LP to a partner, actual partner, right? That's a pretty good. So they must have been doing something that you liked. And you say your bias towards self-storage. Again, as I said, I think there's a lot of interest in self-storage. We haven't done a ton of it. We haven't seen a ton of it on the marketplace, but there's certainly an attraction to that as an asset class for a lot of investors that we speak with. So maybe walk us through what it is about self-storage, I guess generally that you like, and then also kind of where we're at right now in the current market cycle and some of these inflationary and kind of interest rate pressures we're feeling, how you feel about self-storage looking forward.
Yeah, let's take that question in two parts, right? Part number one is, I guess, the original thesis around why self-storage. And how I looked at it, and again, I'm just looking at numbers, and I'm a big believer that essentially, if you go back and look at the data long enough, you can kind of see what's going to happen in a particular asset class. And so there's a data set that I really like, and I can certainly share this with you so that you guys can put it in the show notes. But it's the National Association of REITs. They track all of the publicly traded REITs. Essentially for the last 28 years, they have data since 1994. And you can compare and contrast asset classes, right? So you can look at how multifamily did versus apartment or versus retail versus office versus self-storage. So self-storage in the last 28 years did just under 19% a year, which is incredible. And it's outperformed most of the major asset classes, certainly the core four, like apartments, retail, office. So historically returns are really strong. And then I'm also a believer that everything is going to correct, right? There's going to be cycles. And in a downturn, what happens to storage? Well, at the time, this was pre-COVID, obviously. The most recent cycle was the Great Recession, right? So 2007, 8, 9. And storage lost less than 4% of its value there, where apartments were closer to 7%, office was in the double digits, retail was lost 8, 9% over that 3-year period. S&P 500, by the way, was down close to 22%. So, there's a reason people are seeking alternatives. But so you had this asset class where historically did very well, and then even in a market downturn performed very well. And then the third reason, and this is the thing that really stuck with me, and is our thesis at Reliant, which is the market is still very fragmented. So there are 5 publicly traded REITs in the space, real estate investment trusts, and they're the big boys. If someone's listening to this in their car and you look outside your window and you're on a major highway, pretty much off every exit ramp, you're going to probably see one of these, Extra Space or CubeSmart or Public Storage. They own about 30% of the market when it comes to square footage, and the rest is still very fragmented. So the statistic I like best is about 55% of the square footage in the US is owned by operators who own less than 5 facilities. So what that plays for all of you private equity wonks out there, that's a consolidation or roll-up strategy, right? Where you have the opportunity to bring a portfolio together, and at scale, it's worth more than the sum of the individual parts. So that's, for me, why I really liked the asset class, was that consolidation and roll-up strategy. So that was really the kind of the 3 reasons why.
Yeah, and I think a couple of those that you mentioned, the recession, not proof, but resistant, right? That storage tends to hold up fairly well through challenging market cycles. I guess that's maybe kind of to the second part of my question, where we're at right now. Historically, self-storage has held up fairly well through down markets, right? And I think as a society, we're not going to be shedding our dependence on acquiring stuff. And so that would bode well for storage as a sector going forward, typically, right?
Yeah, I mean, the thing that we look at, we joke, it's the 4 Ds of self-storage demand. These are the things that if they're happening in your life, they're generally driving demand. And so those are death, dislocation, downsizing, and divorce, right? So if those are happening in your world, generally, that's when you're going to consume self-storage. Does it make sense? Mm-hmm. So in a recessionary period,
yeah,
those things all happen. In 2021, COVID for the asset class was one of the best years in the history of self-storage. And for us as a company, one of the best years in the history of our company. Because during the pandemic, you had all of that. Unfortunately, a lot of people were passing away. People were moving everywhere. They were downsizing because they didn't have to work in the town live in the town that they were working. So they were moving all over the place. And, if I worked in New York and said, hey, I'm going to go out, buy an RV and travel around for 6 months, they put all their stuff in storage. So demand was off the charts at the end of 2020 and through 2021. Now it's coming back to earth now. But it kind of speaks to that recession resiliency that you mentioned, Adam.
Yeah, and we've talked on the show before of with COVID and everything that caused. Some of the asset classes have had what I would consider fundamental shifts of how that space is used. Have you guys seen anything through COVID that you feel is a longer term shift that's here to stay, or is that more of a business will return as usual within self-storage, right? I mean, it's not incredibly complicated what's done in the space, right? You store stuff. Have there been any
We're doing God's
shifts?
work here, Adam. This is basically brain surgery.
Well, coming from where you were before, I know you were in the some pretty complex medical sales stuff. So so maybe that's a bit of a return back to storing stuff. But I mean, and have you seen any what you think will be long-term fundamental shifts to your asset class as a result of COVID, or is it more of a getting back to maybe business as usual out of the health crisis?
Yeah, that's a fair question. I think there were two things that we learned during the pandemic. Number one, which was transitory, is that the tenant base became much stickier. So their average tenure in the units was longer during the pandemic. Now, some of those people stuck on, right? As we've, we're recording this August 31st. I guess depends on where you live in the country, but is COVID over? I don't know how to, answer that question. But, as we came through the pandemic, tenants were stickier because they weren't leaving. But the thing that's longstanding that was a huge shift, and if you weren't ahead of this, you lost a lot of that opportunity, which was touchless leasing. So the ability for a tenant to never go into an office to rent their unit was huge. And if you didn't have that infrastructure to support it, people didn't want to be around people, but they still wanted access to their units or leasing online. So that's a piece, I think, Adam, that will be a forever in self-storage, right? Yeah. As more technology takes hold in the asset class, we're going to have less people interaction. And we're always balancing that as an operator, because payroll, taxes, and insurance are our biggest expenses, right? So, on the payroll side of things, if we have the opportunity to reduce hours in the store and supplement that with technology, well, that increases net operating income, which arguably is increasing value if all of the things are equal. So it's always a balance. But I would say, if you said, hey, Kris, what's the biggest shift since the pandemic? I would say the ability for touchless leasing, where a tenant, doesn't have to interact with the office staff if they don't want to.
And then when you look at the migration or movement of people as a result of that, have you seen, I don't know if you have this data or just anecdotally, I'm curious, do you see is there more demand where people are leaving their stuff behind and relocating, or is it they're getting to a new spot and then you're seeing more demand in the places they're locating to, right? So I guess, how did you see the demand shift from more of the urban markets that we're seeing more of an outbound migration versus some of these secondary markets, lifestyle cities, wherever that might be, where they're seeing more of an influx of people coming in?
Yeah, I really can't speak to the outbound because our primary markets, so we have 78 properties as of today, and almost all but 4 of them are here in the Southeast, right? So Florida, Georgia, North and South Carolina, Alabama, Tennessee. So we got a lot of that influx, right?
Yeah.
So, people leaving the Northeast or, California or wherever the case may be, we got a lot of that influx. I mean, if you look at the net population migration data on what's happened in the Southeast in the last 10 years, it's pretty incredible. I mean, not just 2021, that shift has been going on for a while. So, I would say that for us, I can't speak to the outflow. We've been more the beneficiary of the influx of people into our markets. The other 4 properties we own are in Colorado, where we've seen similar shifts, right? Colorado Springs and Brighton, and people are coming to those towns because they want the lifestyle as well as the ability to to have a good work-life balance.
Yeah. So when you're looking at markets, what do you like what are some of the factors that you like the most about markets that you're currently in, or when you're looking to expand into a new market? What are some of the drivers, or is it tied to population growth? Is it migration? What are some of the factors that you all look at, either in current markets that you like, or when you're looking for a new market to expand into?
Yeah, it helps, right? I mean, we're looking at the same demographic drivers that probably every asset class that Real Crowd has interacted with is, right? So things like traffic count and population growth and job growth, those are all important things, right? If a market is stagnant or slowly declining, generally that's not a great thing for your tenant base. But you have to have some context into self-storage, and I'll try to explain it as quickly as I can. Storage is a very micro market game. When we look at an addressable market, we used to look at kind of a 1, 3, and 5 mile radius around the facility itself, right? And said, okay, if I live in one of those concentric rings, this is my addressable market. Well, we've since even pared that down to drive times, where we're looking at 3, 5, 10-minute drives. Because remember, it's a garage. Right? So there aren't specific amenities. I mean, if it's nice and it looks safe and smells good, generally that's it. There aren't school districts or pools. So like where apartments, someone may drive for those things that a particular market doesn't have. In storage, if it's not convenient to your work or your home, generally you're not going to choose that facility. Does that make sense?
That does, yeah. And so
when we do, sorry.
Just say, so when you look at the drive time, you said, what were the amounts of time you look again? Was it 5-10 minutes within that?
Yeah, it depends on the market. If we're in more of a tertiary or rural market, maybe we extend that a little bit. It really depends on how much competition is in the space, right? Well, that's what we're trying to ascertain is what is the supply in that addressable market. And there are some metrics that asset or operators use. You'll hear a number called 7 square feet per person, which basically you take a population in a 1, 3, and 5 mile radius and say, all right, if there's 100,000 people in a 3 mile radius, then you should have 700,000 square feet of storage, and that's equilibrium. And if there's less than that, then the market is undersupplied. If there's more than that, then the market is oversupplied. If you look into the math on where that comes from, it's very wishy-washy. I think it's just developed to make us all feel good that
gives you a number
we're using some sort of, we're like, oh, look, this market's undersupplied. So what we try to do is just really tell a story around the market. All those demographic things are important. If you said, hey, Kris, you have to pick a market based on one metric, I would choose, tell me the competitive set's occupancy. If there are 10, in that drive time, if there are 10 competitive facilities and they're all at 95+% occupied, well, demand's pretty high there. If everybody's at 70 and there's 4 facilities that are new coming out of the ground, and they're going to have to go through a lease-up period, that feels like that market might be oversaturated. So, it's if our acquisitions team were on the call with me, what they would say is we're trying to understand the story of that addressable market and where we fit in it.
And then once you're looking, assume you've got this 10-minute drive time and you have a appropriate number of population within that 10-minute drive time, what are some of those maybe secondary factors that are kind of go, no-go decisions, right? What's a flashing green light and what's an absolute red light? We're not going to look at this as an opportunity.
Yeah, let's start with the flashing red light. That's the easiest to answer. Generally, it's rates and supply. So we can see, what the rental rates are that our other operators are charging, right? So we're underwriting. We're not, if we're above market for a 10 by 10 climate controlled unit, we're not going to rent, right? It's again, we're not any better or worse than the garage down the street. Maybe our facility's cleaner, and sometimes that matters. If the competition is non-institutional quality, they're all mom and pop operators and we're a flagship in the market, sometimes we can get a rent premium for that. But generally, we have to be within the realm of market rates. So, the flashing red for us is if rates are trending downward, meaning everybody is lowering rates to try to boost occupancy, that's usually a red flag. If you look at a 12-month window and see that everybody's lowering rents and occupancy's going with it, that means generally you're oversupplied in the market. And then the other thing that's a real, watch out for us is the new supply that's planned, right? So, if in our addressable market, there are 2 planned developments coming along and everybody else is, 80% full, well, that's going to put a lot of strain on all of the operators in the market because it's basic economics. If there's too much supply, price drops. And generally, when new assets come to market, the prices are really cheap to get the leases to get them full. And then once they stabilize in occupancy, then you'll start to see those rates tick up. But for us, that's kind of the flashing red is if there's a bunch of new supply coming to town, we probably don't want to be there unless there's something else happening that's really, all the new supply is coming because the population growth is off the charts or something along those lines. And that sometimes happens. So again, it's the story of the market that we really like to dig into.
And then what about we have to do this deal?
Yeah, a couple things there. For us, we're a value add shop, Adam. So our play 8 times out of 10 is we're buying an existing asset and we're adding square footage to it. So we're adding additional square footage and units, and then we're trying to get those units leased up. That's where our NOI growth is coming from. We focus very much on pure NOI growth because we can't control what cap rates are going to be, right? 6 years from now, I have no idea what values are going to be, and you don't either, Adam. But if you do tell me, and we'll make a lot more money than we will in self-storage.
I don't profess to be. That's what's the beauty of being on this side of the microphone is I get to ask you those questions. I put you in the hot seat.
And what I would tell you is nobody knows, right? So it's a fool's errand to try to predict what the future is going to look like. But what I can say is all other things being equal, if we can grow net operating income, it's going to turn out okay. And so that's what when you say what's the flashing green for us, it's really opportunities where we have a fantastic expansion opportunity and there's low-hanging fruit potentially around a mom and pop type operator, right? Someone who maybe has some deferred maintenance, the property has not been kept up to snuff, and there's an expansion opportunity for us. And it's in a market where the competitive set doesn't have a lot of new development or the competitors are mom and pop operators. That usually gives us a really unique position. Like, let me just use one example. We have a pretty sophisticated, we're not the most sophisticated, but digital marketing, right? So if you Google self-storage in a town we're in, generally, we're going to pop up on Google. Well, mom and pop operators generally have websites, but they don't have a sophisticated digital marketing strategy, right? So if we go into a market like that, we instantaneously, instantaneous is too strong a word. Within a few months, we can rank really high on organic SEO search, right? And maybe we do some Google paid ads where some of that competitive set is not doing that. So, in those types of markets, just allows us to, be an institution, a big fish in a small pond.
And now, when you look at that value add, and I'm just thinking back through my various times of storing stuff throughout my life, you've got when you look at like a multifamily, right? I mean, there's fairly standardized process there. And I'm just thinking mainly to like construction type, right? You've got everything from stick built to very, steel construction, aluminum walls to cinder block to now we're seeing multi-story tilt up construction in urban markets. Like there's such a broad category of just even construction type, right? I mean, how do you guys focus on a certain type of unit? Is there strategies there based on the kind of property? Is that an indicator of quality? Like how do you think about just the vast different construction types within the storage industry? Because like you said, a lot of it is those smaller, local mom and pops that aren't standardized in even construction methodologies, right? I guess, how do you make sense of that given such a variance there?
Well, I think and I hate to give you the answer of it depends, but what I would say is we're opportunistic and is very market specific. Mm-hmm. So, each market potentially has a different type of demand as well, right? I mean, if we're in South Florida, generally everything's climate controlled because it's very humid. And if you put stuff in an outdoor unit, you're going to have mold and mildew and those types of things, right? So if we're doing an expansion, generally it's what the land will allow, right? Or the municipality based on their zoning regulations, and what we think the market is has demand for. So I don't want to say it, I would say the best way we look at it is opportunistically. We'll look at anything and then try to make an informed decision on, all right, where is our best bang for the buck? Sometimes that expansion, Adam, is not storage. Sometimes it's covered boat and RV parking, right? We have a facility in Melbourne, Florida. We opened almost 200,000 square feet of covered parking, and it was full in 6 months. And, it's because, during COVID, everybody bought boats and RVs, and then they have to have somewhere to park them because their HOAs aren't going to let them put them in their neighborhoods. So, it's very opportunistic. I know that's not a great answer for everyone, but that's kind of I don't want to say secret sauce. That's making it sound, too sexy, but it's the idea that we look at a market and say, all right, what can we do first? And does that fit in where we believe the demand is going? And then we try to make a good decision that way.
Yeah, and I guess maybe that's what I was getting to, right? The variability of those different ways, right? I mean, you look at a multifamily project and you could only do so much to add value within a unit, right? You can renovate the common areas, do a gym, do, a dog park or whatever that might be. You can put new countertops, right? But that's fairly programmatic, I guess. And it just seems like there's so much variance within the storage market. Things like you said, right? Doing covered RV and boat storage, climate control, all these other, again, looking at maybe going up multiple stories. It just seems like there's so much variance in what you can do to add that value, the creativity there. Is that a challenge to kind of keep focus on those, or is that more of the opportunity that you guys see?
So I think that's the fun part, right? It's not always the same. And that's the challenge in getting it done and kind of having a vision come to fruition. You're right. We can't put, granite countertops, hardwood floors, and stainless steel appliances and charge more rent, right? That model doesn't work in storage. So it's really about, and this, I'll give all the credit to Todd Allen, who's the managing partner and founder of Reliant, or one of the co-founders. That's his sweet spot. He loves to go look at a facility and say, well, what if we did this? And then acquisitions and construction are building around that idea. Well, no, the city won't let us do that. So we got to try this. All right, well, let's tweak that and we'll go here and do that. And so, it's a constant kind of push and pull to maximize our best bang for our buck on our spend and where we can get the most NOI growth. Because again, Adam, if you boil down everything we do, it's really how do we grow net operating income, right? That's what our operations is focused on. That's what construction is focused on, acquisitions, and obviously on the investment side, that's what our investors should be focused on as well.
And so when you've acquired the property, you've owned it for a couple of years, you've gone through this value add strategy, and I guess maybe preface that with let us know what is the timeline of that value add strategy? Maybe how does that compare to like a multifamily value add property? And then how are you looking to the exit? How do you know when the right time is, or what are you looking for when it's the time to exit a property?
Yeah, let me touch base on the first part of that question as far as the timing of the value add. So generally we're underwriting market specific, and certainly in the last year it's been much longer than in most cases what we underwrote. It depends on the municipality, but somewhere in the 14 to 16 month range to get something permitted and built. Now remember, these are facilities that they're already zoned for self-storage. We're just adding more of it. And in some, especially the smaller markets, the tertiary markets, that might be, a process of a day. But in some other larger secondary markets, that process can be pretty tedious. So I would say generally timing for expansion is, year to 18 months to get the construction completed. And then generally another 18 months of lease up. We've had some that have leased up much quicker than that. We've had some that have taken a little bit longer than that. And so that's always the balance. I usually, if everything goes to pro forma, our original model, which it almost never does, both to the good and the bad. Sometimes it's better, sometimes it's worse. But if it goes to the model, generally somewhere in year 3-ish, we're hoping to reach both physical and usually economic stabilization on the occupancy side. And at that point, Adam, that's where, in the last, call it 5 years, where we've seen excessive cap rate compression, that's where we've said, okay, is it time to trade? And to your question of how do we evaluate when we trade or when we sell or have a liquidity event, generally it's two things. It's what is our return on equity, and that's the equity we've created, right? So, you put $100,000 into a deal and it's worth $100,000, and then 3 years later it's worth $200,000. Well, your cash on cash return isn't based on your $100,000 originally in the deal. It's on the $200,000 that your property is currently worth. And so, we have some scenarios, which is a blessing and a curse, where we're able to build value very quickly, but then our return on equity in the deal becomes pittance, or, not what it should be. And we feel like there's a better opportunity if we, have a liquidity event, take that capital out and go redeploy it. Let me give you just a quick example, Adam, because it speaks to it perfectly. So our first fund we launched in 2019, and it was projected to be a 6-year hold. And we raised $50 million of equity, had 11 properties in it, and the plan was, about 8 of those properties had value add. So we would go out, do our value add strategy, get that NOI up, and then look for a liquidity event. Well, in year 2, we got an offer for those 11 properties that basically we had projected in year 10. And so we're looking at saying, okay, we'll take that off the table for our investors, and
sounds good.
Hopefully use those dollars to reinvest in the future. And look, that's, 2021 was crazy.
Yeah.
But those are the kind of things we're always kind of balancing against to say, is it time to recycle that capital?
Yeah, that makes sense. So I guess as we think about from the investor lens, you mentioned some resources, obviously tracking the NAREIT index and seeing self-storage within there. Are there any other key data points or metrics or sources that you all look at that investors who are interested in self-storage should be paying attention to, and maybe some of those, again, the resources, we can put those all in the show notes for people listening?
It depends what you're looking at, because remember, some of the national data, it may tell a story around the macroeconomic climate of storage, but that doesn't mean there aren't specific opportunities, right? So if the rental rates in Atlanta, Georgia are all going down because we're oversupplied, well, that doesn't mean everything in Atlanta there's no opportunities, right? Because remember, it's that micro market. Yeah. From a learning about the asset class, there's a great resource. It's called the Self-Storage Almanac. It comes out every year by Self-Storage or Minico, which is an industry publication. They've been putting it out for 25 years. And it's a great, snapshot of the industry, what's happening, and some of the data around the shifts in different markets. So that's a great read. It's long. It comes out every year. You can download it. I think they'll probably charge you. But you can download the Self-Storage Almanac. I mean, look, for your investors that are on this podcast, I assume most are seeking passive investment opportunities where, they're looking for sponsors to deploy capital with. And this is my own personal philosophy, and it's been this way since I first invested with Reliant and what I do outside of Reliant. I start with the team. I really want to understand who the people are in the deal. Because ultimately that's who you're investing in. Yes, if you deploy capital with Reliant, it's getting deployed into self-storage, but ultimately it's the people at Reliant that will determine the outcome of that investment. So I spend a lot of time on the team, and then the other thing I like is track record, right? Understanding what have you done historically. And although it's not perfect, a perfect indicator of what's going to happen in the future, it's the best thing I got, right? Because it's really hard to predict the future. So if you got great people who've done something really well historically, generally that's probably going to turn out okay in the future. And there's going to be bumps. That's the thing, is that's where you want to have great people. When things go south, and they will, who are the people behind the organization, and are they acting in your best interest? So, that would be my, if as people look to self-storage, yes, understand the markets, understand what the business plan is by the operator, but really dig into the people and the track record, because I think that's going to be your best bang for the buck as far as the due diligence you.
Yeah, and that's great feedback, and that was going to be one of my next questions. Is given your path to where you are, again, investing as an LP first, right? What were those things that you were looking for? And that's 100% online with what we always say. You pick the jockey, not the horse, right? It's manager, and making sure that you're comfortable and can build the trust with those sponsors. And that's something that we've always encouraged, is that direct relationship and communication between the investor and the manager. And I think there's, for investors that maybe aren't as experienced, or this is their first time looking at some of these asset classes, there can be an intimidation factor of, oh God, do I really want to ask this question? Like, am I just going to annoy them? Why would they talk to me? Kind of a thing. Most of the managers that we work with welcome those questions, and they love talking to investors, right? So I guess from your path of LP now to operator, any advice or encouragement for investors that are listening that maybe have questions, but they're just not comfortable asking them?
Yeah, I mean, my first piece of advice would be ask them, or don't go into something that you don't understand why. Like, what's the why behind it? Why is this going to work, and why is it not going to work? And if you have a sponsor that pushes back on you, run away. If you're pushing into things and a sponsor is pushing back, that is a big red flag. And the other advice I would say that surprisingly very little people do is just do a Google search on the principles of the company. You'd be amazed at what you'll find that is just out there on the public record. And if it's a sizable chunk of capital, maybe you come out and visit the team and understand who those people are. I know that's not feasible for everybody all the time, but whatever you can do to get comfortable. And to your point around investing in the jockey, not the horse, the thing I love is I like to be one person away from my money, right? So the idea, if I buy a share of Amazon stock, Jeff Bezos will not take my phone call ever.
No.
So, but at Reliant,
there. I thought you had some connections.
No, definitely
right.
do not. But at Reliant, you are, you can talk with our investor relations team, and if an investor is like, hey, I'd like to talk with the principals of Reliant, okay, we'll talk to you. Now, it's not scalable. We can't talk to everybody all the time. We have 1,800 investors in our platform, and we are trying to run a business. But I will say that, generally you're one or two people away from how are the decisions being made for your capital, and ultimately those are going to drive the outcomes.
That's perfect. Well, I know we've got to wrap up here. As we ask these kind of final questions, again, keeping kind of in mind the investors' outlook here, when you're looking at self-storage, and we touched on a little bit of this, what are some of the areas about the industry or about the environment that we're going into that has you maybe a little bit worried or concerned, or things that are keeping up at night about where self-storage is going?
Yeah, that's a great question. Let me start big, and I'll kind of get to the small. So macro, right? If I think macro, the big fear is disruptive, right? If I'm a taxi driver and Uber shows up, that's a game changer. And there are some of those models out there right now. Valet storage is essentially the kind of the category where things are picked up at your house, and then they are whisked off to an industrial warehouse somewhere, and then if you want them back, they're delivered. And in big metroplexes, it can work, and that model's still being tested. Nobody's really solved for it yet, but in smaller markets, it's expensive, and they haven't quite figured it out. That may be a disruptor, right? That might be a shift. I don't think consumerism is going to change. Americans are just going to decide all of a sudden, hey, I don't need this stuff. At least not in a time frame that your investors listening are going to care. Maybe generationally that shifts. So macroeconomically, that's kind of what I think about. On the current environment where we are today, rising interest rates are a concern, right? Generally, for people not familiar, if interest rates are rising, capitalization rates or cap rates are also following. And when cap rates rise, it just means that there's less money chasing deals, and so prices go down, right? It's, again, supply demand. If there's a lot of money chasing deals, then the prices are going to go up, just like we've seen in the single family residential market in the last year. Well, now people have stopped buying houses and prices are adjusting. Same thing happens at commercial self-storage. So, I think we'll see what happens with the Fed. Obviously, Jerome Powell is saying we're going to continue raising rates until we've fixed inflation. There will obviously be some political pressures that play into that as well. But I think interest rates are probably the risk we look at now and say, okay, how does this play into our model? And this is where, Adam, for us, the NOI growth is even more important, right? If the cost of our capital is higher and we're putting debt on all of our properties, generally 65% loan to value, if we're putting debt on our properties, well, now it's more expensive to get that debt, which affects the returns for our investors and for Reliant. So I think that's the thing we think about right now. Do the inflationary pressures continue? Which I think storage is actually uniquely positioned to handle. Our leases are 30 days, so we can adjust prices quickly.
Yeah, so I was going to say that's the multifamily is typically the asset class that most people turn to in terms of the kind of inflationary hedge, and you can capture that inflation annually with these lease rates. But I mean, hotels, nightly rates, right? Super flexible there, and you're talking monthly rents. So your ability to almost real-time price with those pressures, right? I mean, that's got to be a huge buffer or hedge against these inflationary pressures to be able to capture that in these monthly lease adjustments, right?
Yeah, to a point, right? But at some point, your competition becomes the dumpster, right? Inflationary pushes and pushes, but there's a point where people can't afford to do it anymore. So yes, we have the structure to adjust, but you're starting to see that in the multifamily space now, where rents are starting to soften a little bit, because I think we're starting to hit the cap on what people can afford, right? And so that affects us as well. But yeah, we're uniquely positioned versus let's say office, where sometimes those leases are 5, 7, 10 years. And if your rental rate isn't capturing, the rental rate escalators aren't capturing your inflation, you can be stuck in a contract that's not so beneficial for you as an operator or investor. So that is one unique option for us. But, time will tell. Everything is cyclical, right? And there's going to be some ups and downs along the way. And ultimately, I think it's, you try to find the thing that will push you through any economic environment. And for us, that's always been, let's just grow NOI. In long term, that's going to turn out okay.
Perfect. And then the flip side of the what's keeping you up at night question is, what has you most optimistic about the future of self-storage?
Yeah, I think for us in particular, we're a top 20 operator, right? So we're the 17th largest self-storage operator in the U.S. What we see is that consolidation play. There aren't too many operators at our scale that can bring a portfolio of our size, right? So there's a unique opportunity, I think, for Reliant there moving forward. I think in the asset class, Adam, what I don't believe is going to change is people have figured out, maybe I don't want to live in Manhattan or LA, and there's some pretty awesome spots to live around the country that are tax advantaged and have better weather, and we've been the beneficiary of that. If I think about it, I think we see people more transitory. So migration generally is good for storage as an asset class. And then, the other thing that's happening is we're seeing, people move in together as prices rise, right? So you have a roommate, and when you don't have room for your stuff, it ends up generally in storage. And so, some of these short-term pressures for us, we believe are going to be, good for the asset class. Again, parlayed against, maybe a rising interest rate environment. So we feel like the asset class is strong, and then where Reliant's positioned, allows us to be positioned well for a potential roll-up in the future.
Very good. Well, Kris, I think that's a good spot to end it. This has been a fascinating conversation, and thank you again for sharing your thoughts today. Why don't you let listeners know how they can learn more about what you and Reliant are up to?
Yeah, for sure. Probably the easiest way is through our website, reliant-mgmt.com. So the abbreviation of management. That's probably the best place to learn more about us, team, track record, our current investment opportunities. We post a bunch of stuff. If you search me, Kris Benson, it's Kris with a K on LinkedIn. We also post a bunch of stuff there as well. And if we can provide any more information or someone's looking for investment opportunities, let us know, and happy to explore it with you.
Perfect. And we'll have links in the show notes to all those things that we talked about today. So Kris, again, really appreciate it. Thanks for coming on the show.
My pleasure. Thanks, Adam. Have a good rest of the day.
All right, listeners, that's all we've got for today. I hope you found that enjoyable. If you have any questions or comments, as always, send us a note to podcast@realcrowd.com. And with that, we'll catch you on the next one.